Hi, I'm Tom Lydon, editor of ETF Trends here in Orlando, Florida at the TD Ameritrade Institutional Conference. I'm here with Ben Johnson, Director of Passive Fund Research at Morningstar. Ben, great seeing you again.
Great to be here, Tom.
We've had a lot of time together in the last couple months, and it's been an amazing period to kind of watch the evolution of what's been going on in the ETF industry. On the active side, I mean, there's a lot going on there too. Kind of what are your thoughts? What are some of the areas that you were really looking at Morningstar?
You're right, there's been a ton going on. It's been ETF week down here in Florida.
Right.
We've been crisscrossing the state. We had interesting news out of PIMCO this week. PIMCO filed to launch 19 new actively managed ETFs that would essentially mimic or sort of parrot the strategies of existing mutual funds. Now, I think this is interesting because it is evidence that PIMCO gets it. And when I say PIMCO gets it, they get that the ETF really at its essence is just a distribution mechanism. It's a new way to deliver a similar strategy to end investors, no different from a mutual fund, no different from any of the other distribution mechanisms available to asset managers to deliver their strategies to the end investor.
Right.
So PIMCO gets it.
So they're not saying, hey, mutual funds are the be-all and end-all, maybe I'll try ETFs. They've already tried them. And now they're saying, look, it works. It's not cannibalizing their business at all, would you say?
They've tried them and they've succeeded.
Right.
I mean, if you look at active ETF assets, we spend a lot of time talking about these things, they still account for less than 1% of all ETF assets. Mm-hmm. Of that tiny sliver of the market, 2/3 of that money is actually in PIMCO funds. So if you look at BOND, you look at Mint, those have been the two real poster children for success in active ETFs, and they've been successful because they're just a new means of delivering time-tested strategies from well-known managers from a great parent firm like PIMCO.
Yeah, absolutely, and the timing has been great too as we face this rising rate environment. So what do you think in general as far as other big Wall Street fund companies? Do you feel more will be following suit, or to a great degree they're trying to maybe get into the space from a non-disclosure standpoint? I know we don't want to spend a lot of time on that, but still, there are a lot of big companies that just haven't been in the game yet.
There are a lot of blue chip asset managers right now that are all lined up around this cold pool, watching Bill Gross and company, do the backstroke and have a good time, and they're thinking about jumping in. Uh-huh. They have some hesitations though, hesitations around transparency, hesitations around potential cannibalization of existing lines of business. And in some cases maybe these are warranted, in some cases maybe not, but I think in the coming years, especially if we see the SEC sign off on non-transparent concepts, more and more of them will be jumping in the pool.
Well, it's a great game to watch, isn't it? I know we're having a good time. Let's switch over to smart beta. Smart beta has been the area that many thought the active area would be getting the assets, but this middle ground, moving away from core indexes, is just exploding with many participants and looking at creative indexes in certain ways, right?
Absolutely. In smart beta, what we call strategic beta, it's important to realize that these strategies look a lot more active than they do passive. Yeah. And there's an active decision there. There's an active decision that says, I'm going to stray from this benchmark, or I think this benchmark is busted and I want something more, I want something better. So there's an active element that's still there, despite the fact that these are index products. And you've seen tremendous growth in this space. Right now you've got about 300 billion or so of assets, so it accounts for about 17% of the total ETF pie, but they accounted for about 1/3 of net new cash inflows into ETFs last year. And why is that? Well, you look at some of the underlying strategies and their appeal. A lot of that money has been going into dividend-oriented ETFs.
Right.
People are looking for income high, low, and everywhere in between. So equity income funds have been really successful. People are still feeling burned after getting badly hurt during the financial crisis and seeing big drawdowns in their portfolios. So you're seeing a lot of money flowing into low volatility or minimum variance strategies as well.
Right.
But it's important that investors understand that they're making an active decision by using these products. And while some of these concepts will pan out and reduce risk or improve returns over very long time periods, they're going to underperform as well, or potentially pose more risk over very long time periods.
Right.
So there's no free lunch anywhere. The lunch here is not free.
Yeah.
And somebody's paying for it. So I think it's important to come into this space with eyes wide open and understand the risks.
And that's it, understanding. Morningstar has always had the mandate, be there for the average investor, which requires that much more education. And as more of these smart beta strategies, you and I are going to spend more time working to try
Absolutely.
to educate.
Education.
So speaking of education, you guys have a great conference in the fall, the Morningstar ETF conference. And what are the dates of that?
September 17 through 19 this
In
year.
Chicago?
In Chicago at the Sheraton.
Great.
Yeah.
Well, looking forward to seeing you there. And Ben, thanks again
We're
for
excited
spending
to have
time
you.
with me.
Thanks, Tom.
Thanks.